Ladies and gentlemen, good day and welcome to Max Healthcare Institute Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suraj from CDR India. Thank you, and over to you, Mr. Suraj.
Thank you. Good morning, everyone, and thank you for joining us on Max Healthcare Q3 and 9M FY26 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Keshav Gupta, Senior Director, Growth, M&A, and Business Planning. We will begin the call with opening remarks from the management, following which we will have the forum open for an interactive Q&A session. Before we begin, I would like to point out that some statements made in today's discussion may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks. Thank you, and over to you, Abhay.
Good morning, everyone, and thank you for joining us on Max Healthcare earnings call for the third quarter and 9 months ended December 2025. We are pleased to share that the network delivered its 21st consecutive quarter of year-on-year growth in quarter 3, despite excessive, unanticipated seasonal softness due to lack of vector-borne diseases and transitionary external factors. Revenue increased by 10% year-on-year, while operating EBITDA grew by 4%. Overall occupancies remained strong and ramp-up of the new brownfield beds progressed in line with our expectations. During the quarter, we commissioned 63 brownfield beds at Nanavati Max, of which 45 beds are currently occupied. At Max Mohali, 53 brownfield beds were commissioned in the second quarter, of which 46 beds are currently occupied. The remaining beds at both hospitals are expected to be commissioned during the fourth quarter of this current year, FY26. The incremental bed capacity at both these locations is already EBITDA and margin accretive. At Max Smart, infrastructure for around 200 beds, along with operation theatres and OPDs, is ready for commissioning, and we are currently awaiting the occupancy certificate, which is expected by the end of February. We also took an important step to expand our geographic presence in Western India to develop a 450-bed hospital on a prime piece of land in Pune. This will be developed by 2030. In addition, driven by the exceptional ramp-up in operations at Max Dwarka, the board has approved the addition of another 260 beds at the existing site, taking the hospital's total capacity to 560 beds. On a sequential basis, revenue and EBITDA were impacted primarily due to a temporary shift towards institutional patients following the disruption in cashless services with standalone health insurers, which was fully restored towards the end of the quarter. Performance was also affected by the discontinuation of select high-value patented chemotherapy drugs in light of the revised CGHS pricing guidelines and by the reduction in GST on drugs and consumables. Further, the results reflected pre-commissioning expenses related to brownfield bed additions and other non-recurring costs. Looking ahead, with cashless services now fully restored, upward revision in CGHS tariffs expected to fully kick in by April 2026 and margin accretive incremental capacity coming on stream, we believe the network is well positioned to continue delivering sustained growth. Now coming to the third quarter performance highlights. Average occupancy for the network stood at 74% compared to 75% in third quarter last year and 77% in the trailing quarter, despite an 8% year-on-year increase in operational bed capacity. Occupied bed days were up by 7% year-on-year, but dipped by 4% quarter-on-quarter due to seasonality. Average revenue per occupied bed, ARPOB, for the quarter was 77,900, registering a 3% growth year-on-year and 1% sequentially. Network gross revenue stood at 2,608 crores compared to 2,381 crores in the third quarter last year and rupees 2,692 crores in the previous quarter. This reflects an increase of 10% year-on-year. Digital revenue from online marketing activities, web-based appointments, and digital lead management was 803 crores, accounting for approximately 31% of overall revenue. Website traffic crossed 71 lakhs sessions during the quarter, growing by 44% year-on-year. International patient revenue was rupees 230 crores, registering a growth of 14% year-on-year and accounting for 9% of the revenue from hospitals. Network operating EBITDA stood at 648 crores, reflecting a growth of 4% year-on-year. Network operating EBITDA margin was 26.1% for the quarter compared to 27.3% in the third quarter FY25 and 26.9% in the trailing quarter. Margin was largely impacted by payer mix change, pre-commissioning expenses for brownfield beds, and GST rate changes. Annualized EBITDA per bed for the network stood at rupees 71 lakhs versus rupees 73 lakhs in both third quarter FY25 and the previous quarter. Profit after tax for the network after exceptional items was rupees 344 crores against rupees 316 crores in the third quarter last year and 554 crores in the previous quarter. During the quarter, there were exceptional items aggregating to rupees 55 crores relating to impact of the Code on Wages 2019 and provision for stamp duty on the merger of two of our subsidiaries. The network generated free cash flows of rupees 281 crores during the quarter. Rupees 408 crores was deployed towards ongoing capacity expansion projects and facility upgrades and newer units. Net debt for the network stood at rupees 2,166 crores compared to 2,067 crores at the end of September 2025, while the net debt to EBITDA ratios continue to be less than 1. Continuing our efforts to support the local communities, we provided free treatment to approximately 40,000 patients from economically weaker sections of the society, worth rupees 61 crores at hospital tariff. Both our strategic business units continue to deliver steady growth in revenue and profitability. First, Max at Home reported a revenue of rupees 68 crores, reflecting a robust 23% year-on-year growth. It offers 16 specialized service lines across 15 cities with over 56% repeat transactions. Max Lab reported a revenue of rupees 47 crores, reflecting 13% year-on-year growth. It provides services in over 60 cities and serves more than 5 lakh patients during the quarter. Now moving on to the status of our expansion projects coming on stream in the next 2 to 3 years. Max Lucknow, the current capacity of the hospital stands at 413 beds and we expect this to increase to around 500 beds by the end of this financial year. The radiation bunker and nuclear medicine services have now commenced at the hospital. 500 beds at Sector 56 Gurgaon. The pace of work at site has picked up post-GRAP related disruptions. We now expect to commission the first phase by end of H1 FY27. 100 beds at Nagpur, we have received consent to establish and civil work has started. We expect to complete this project within 24 months as communicated earlier. 400 beds at Zirakpur, Mohali, project work continues to be on track and we are scheduled to commission the hospital in FY28. 200 beds at Max Vishali, we are awaiting environmental clearance and approval of building plans to commence the work on site. We expect to complete the project in 24 months post receipt of these approvals. 397 beds at Patwardhan, all approvals have been received and barricading work is complete. New design for D-wall has been firmed up and the project is now expected to be completed by FY29. And finally, coming to the overview of the company's performance for the 9 months ended December 2025. Network gross revenue stood at 7,874 crores, reflecting a strong growth of 19% year-on-year. Overall network operating EBITDA grew by 16% year-on-year to 1,956 crores, translating to a margin of 26% and EBITDA per bed of rupees 71 lakhs. In the 9 months, we generated 960 crores of free cash flow from operations after interest, tax, working capital changes and routine capex. Further, rupees 1,299 crores was deployed towards ongoing expansion projects and facility upgrades at newer units. Rupees 131 crores towards land purchase at Vaishali, and rupees 146 crores was distributed as dividend. With this, we open the floor for any questions you may have.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Damayanti Kerai, HSBC. Please go ahead.
Hi, thank you for the opportunity. My first question is on your oncology contribution. So during the quarter, obviously, we saw some softness which you attributed to discontinuation of patented chemo drugs for institutional patients. So do you think you can go back to the prior level of contribution from oncology, and what could drive it back?
Well, when you say contribution, this is high value drugs, so the pricing was high in terms of the revenue, but the margins were not substantive, compared to the rest of the business. So, do you mean in terms of revenue, or do you mean in terms of margins?
In terms of revenue, when we look at the contribution from oncology, I think which is part of the presentation, it's around 24% or so compared to 27% last year. So I was referring from that context.
So this impacts CGHS patients only. The institutional patients. So this is the high value drugs, which were low margin drugs, which were being used for actually the institutional patients. What they've done is actually now you have to sell them below your purchase cost. So obviously everybody's discontinued it.
And then the contribution to the revenue mix may increase, but it's a future additional number. Just that it was increasing in the past as well for last 4-5 years as an outcome of what was happening in the society, right? So directly will the number increase? Should follow the same vector trajectory. But let's see.
Okay, so we see this as like one-time adjustment, and then going ahead, the growth.
We continue to talk to CGHS, right? So there's a lot of noise among the CGHS patients, among the institutional patients, right? For example, the CGHS has their own dispensary to supply these medicines. They said that they will like to supply this medicine to the patients. That means when the doctor, this drug is required, then the doctor writes a prescription. They take it to the dispensary, bring the medicine from the dispensary, CGHS dispensary, right? Now, similar tariff has been applied to ECHS patients also, but ECHS doesn't have any dispensary, right? So obviously there's a lot of noise out there. I think let's see how the things shape out. But we are in continuous discussion with the CGHS. Obviously they want to first supply it themselves. Secondly, they're saying otherwise we will give it to you at 70% the MRP, right? Okay. Our margins are less than 20% in these drugs, so there's no question of our supplying these drugs, right? Because I can't be cash out of these drugs while supplying these drugs. So I think that's where the decision is on. We are asking CGHS to give us some top up in terms of cost plus basis, right? So if my cost is, let's say 80, then I'm saying give me some margin, 10%, I'll be quoted to supply at 88 rupees rather than supply at 70 rupees, right? Because I'm buying at 80.
So we believe it is an error on their part when they revise the CGHS rates. This is something which doesn't make sense, because if these are branded drugs and if your margins are let's say less than 20%, way less than 20%, and you have to supply them at 30% discount to MRP, then obviously nobody's going to supply and you're going to have a problem. So we've been talking to them, but because it's the government and everybody sort of agrees, but I guess you have to go through the hoops.
Sure. And in oncology again, I guess we heard about some doctors' team departure, etc. So has team fully back in strength, and what kind of further pickup we can see in the oncology space, leaving aside the CGHS issue, which will, I think, be cleared in some quarters to come?
See, typically what happens is that in organizations like ours, if there is a departure of a certain clinician of a particular thing, there are almost immediate replacements from equivalent institutions. So in this particular case, while you may have heard of the noise of departure, there's already been an addition, and there were big advertisements in the papers. You may have seen it. So we had a very, very large team who's just joined us from our peer, who's sort of replaced that particular team, who's actually gone to that peer. So it's been effectively been a swap, effectively. So
Yeah. Okay. Okay. My last question is on your resolution with the insurance partners. So have you done renewing all the insurance contract for this cycle, and you have nothing pending on that part? As you mentioned,
so
I think yeah.
Two things or three things. I mean, of course, this was disruptive in some manner to us in this quarter. It didn't happen in the previous quarter, but it was. And you may have also read in the papers today that number of complaints of insurance companies actually moved up by 54% in this quarter. So, obviously there was a lot of noise because of this sort of disruption, but all of it has been restored. We have got an increment, and there's also a mechanism which has been put in place that there will be annual increments rather than sort of now having sunset periods. Typically, your insurance contracts expire, and those negotiations take time. So now a process has been put in place where, at least with these insurance companies, there's automatic renewal on pre-agreed sort of increments.
So these annual increments, it's already pre-agreed, or how this mechanism will work out?
That's right.
Okay. It's an annual revision for all the contracts now, instead of, say, 2 to 3 years cycle earlier.
Well, not all. These are all the SAHI companies.
Yeah, once where we have the issues, right? So the whole issue started from the tariff revision. We were asking for price increase, they were asking for price reduction. That's where this whole stalemate started. So eventually we got a price increase, and also while we got the price increase this time, we also sorted it out for the next year, next cycle, I would say. So there's a mechanism in place now. So hopefully they'll live up to it, and so we should not have the same kind of statement coming up there.
Okay.
But this is only with the companies that we have problem with, right? 4 companies basically.
So how many companies? Sorry, 4 companies.
Four insurance companies. There are 4 insurance companies.
Okay. Thank you.
So now with those 4, there's not only this thing, but like Yogesh has said, this was an issue at the end of a cycle. Now a mechanism is put in place that you have automatic renewal of that. So we shouldn't have these issues coming into the next cycle or anything like that now.
Got it. Thank you, Abhay. Thank you.
Thank you. Next question comes from the line of Shaleen with UBS. Please go ahead.
Yeah, I'm audible.
Hi, Shaleen.
Hi, sir. So, continuing from some of the question asked by the previous participant, possible to get the quantum of increment, or at least can we compare what kind of increment will be getting compared to the past year for insurance companies?
So Shaleen, tough to really give it on the call like this, right? So we got an increment, right? That's for sure. It's a moderate one, but then I won't give you a number.
Okay. But is it in the ballpark of the kind of increment?
It's not adverse.
Yeah.
It's not adverse. Great. So
it is in the ballpark of what you will see.
Yeah, it's a upper revision and it's in the same ballpark. Yeah.
Got it. Sir, one concern which we kind of, there's a debate, this happened with these 4 companies, can it happen with others as well? So do you think that can happen? Second, do you think that this kind of mechanism can smoothen out? Are you trying to do this?
I think, there are learnings when something like this happens, right? I think it has also led to a lot of noise both ways and inconvenience to patients, not only our patients, but also to insurance patients. And you would have read there's a big article in ET today about the number of complaints which have sort of increased. And hopefully everybody sort of, learned from it. By the end of the day, and I keep saying this, I said, look, medical inflation is in very low single digits. If your RPOP is only 8 or 9%, typically, which historically has been growing, That is included growth in oncology by 25 odd %, growth in robotics by 40 odd %, growth in international patients, etc. I mean, if you actually back it all off, what is the real growth in apples to apples medical costs? And then you apply it to 70%, because 30% is at MRP in any case, which are drugs, right?
Mm-hmm.
So, I don't think there is much sort of play there. I mean, you hear of anecdotally these issues, those issues, and so on and so forth. But the fact of the matter is, this is the apples to apple inflation has only been this much, right?
Sure. Fair enough. Moving on, I heard partly of your initial commentary, maybe I missed something. I heard that you talked about the EBITDA contribution from Nanavati and new facility from Nanavati and Saket is already accretive. So,
yes.
Is it fair to is it possible to understand that obviously when you started these things, there will be some incremental cost which would have hit you in the quarter. Is it possible to quantify that kind of a cost?
I think what happens is that, and this is something we've guided to in the past, where people have sort of had concerns over capacity expansion, etc. We've always said that essentially what you're doing is you're moving cash from your balance sheet and you're creating an asset, right? Because of the operating leverage, it is almost, you don't have suppression of margins. In fact, the break-even is almost immediate and it's accretive also very, very quickly. Okay, and this is what we've seen in the past, and I think this is what we demonstrated by both of these. The cost, whatever little cost there is also, for every incremental bed which gets commissioned now, okay, your margins will only expand. And we had a 39 and 30% respectively, I think, margins from both these units, okay, where we only started about 50 or 70 odd beds, right?
Yeah.
As you are going to be adding beds, and all of those beds are coming through now as we speak, and will be all through before end of March. So you're going to see you should continue on this accretive journey. Now the question is, what is the sort of this thing? Now, if we've had grab 4 delays and etc. in this thing, and yes, of course, we've, I think, built close to 2.5 million square feet over the last 3.5 years, Kishan. Okay, and the fact of the matter is there has been a delay of 3 to 4 months, I think, collectively if you look at it, and nothing has actually moved out more than 6 months from a timeline standpoint. But, at one point of time, this is what we had guided in terms of time, etc. On the other standpoint, you look at it, okay, 3 years projects that take another 4 to 5 months, but, it's perhaps faster than what most developers deliver from that standpoint. And we, of course, continue to ask more of ourselves, and, there's been a lot of learnings in this. The fact of the matter is that pre-commissioning, okay, those costs have been sitting in this thing. But it's not as if they're sitting and not contributing. If you bring doctors along, they perhaps don't contribute as much, but they do contribute to the previous facility. So it's a little difficult to dissect the costs from that standpoint, because, there's no management cost like I already explained. Okay, largely the clinician cost is the same. Now you're going to bring housekeeping people, you're going to bring nurses, you're going to train them up, the front end staff and so on and so forth. Okay, but they're also training in the current facilities. You're overstaffed in the current facility, and then you're going to start to move them into the new one. So, it's a little difficult to thread that cost out, because it's not like a typical greenfield.
Sure.
Do you have a number?
See, basically the reason to ask, a lot of things have happened in the third quarter, and that has kind of hurt our profitability. We understand that there's going to be a step jump from the third quarter to the fourth quarter in terms of profitability, because a lot of things have been corrected, and even new facilities have come. It will help us to understand what kind of a step jump, because
I think the big. Yeah. So I think these are the smaller factors which have affected the profitability. If you ask me, the 2 big factors perhaps which have affected would be, in my mind, first and foremost is the seasonality, right? Last year, right up till Diwali, we had a very, very strong vector-borne season, okay, and large occupancies. Because of dengue and so on and so forth, which has happened historically as well. This year, okay, there were extensive sort of, there wasn't really, this rainy period continued straight into winter. And there was no really stagnation of water from that standpoint. Normally what happens is your rainy season gets over, there's a humid sort of this thing, and then winter starts. So in this period is when you have, the vector-borne diseases. But this year, the rains continued right into the foot of winter, and then winter started. So there was no humid period for, that kind of. So we've had very bad seasonality. So, you've seen results of other sort of companies as well, particularly north-based companies, and you see this effect. And the second was, of course, disruption. Now, when the disruption happened of the SAHI companies, we've replaced all of that with institutional because that's the easier part to replace it with. So you see institutional businesses move up, right? So your occupancy didn't get impacted, but your quality of revenues got impacted, and therefore your profitability.
Got it, sir. Got it. So, any sense on this quarter, like fourth quarter, since we are like almost in the February, right?
I'm not going to give you a guidance. I've never given a guidance on forward-looking numbers. We typically only give it in terms of the new capacities which can come in and what the current sort of run rate of that is, like in the past. So, I will continue on.
Sure. Okay. Last question from my side, if I can, and this is more on the industry level question. So a lot of debate again in this sector is like too much capacities are coming, too many hospitals are coming, and in certain micro market, for example, Gurgaon, right? And hospital is, it's not just the local market, it's also the intercity market, because I also come from North, right? So, I know that. But what's your take on it, right? Do you think that a lot of hospitals coming in Gurgaon can impact Saket, or customer sets are different? Or do you think there will be enough demand, because there is enough intercity travel happening? So I just want to hear your thoughts.
Look, I think there are two or three things over here. I think if you look at it on a holistic level, okay, I think over the next 4 to 5 years, there are about 22,000 beds which are coming up across the country. Right? So, it doesn't really move things over. So over 5 years, it's a capacity increment of, let's say, a CAGR of about, I think, 5% per year. If I look at, let's look at specifically Gurgaon. Now, if a couple of hospitals are coming out of Gurgaon, and we happen to be actually one of them, right? So, I think I'm less likely to sort of take a hit at Saket or anywhere else, because if any of my doctors want to move to Gurgaon, then they will choose my hospital, right? This is sort of easier if that location advantage is valuable to somebody.
Sure.
That what this does, in some manner is, when new hospitals come in, and, so what happens after these 2 hospitals or 3 hospitals which have come up? There isn't a visibility of another hospital coming up in the next 5 years. Because if that was coming up, that some plans would have already getting passed and something would have been built, which is not the situation, right?
Yeah.
Now, when that happens, there may be some temporary disruption of costs. Right? Oh. So your clinician cost at that point of time may go up because you're attracting in that new place, in your hospital, let's say when we put up Gurgaon, when we are going to be approaching doctors, you are paying them more than what they're perhaps earning in the peers. If somebody's trying to take your doctors again, they are going to offer something more. So temporarily for some time that cost goes up.
Sure.
But that's also a temporary factor, right? Eventually, if there's any cost inflation, it does get passed off to the customer. That's what we've seen historically. It's not the first time that you're seeing all of this capacity come up. If you look at the numbers now, we are building another 400 beds are coming up in Saket, which is the center of the city. Now, it's very different from Gurgaon. Gurgaon typically doesn't affect South Delhi, but Gurgaon will affect other hospitals in Gurgaon. Normally it would have affected my small hospital in Gurgaon, but I'm coming up with a big hospital in Gurgaon. Right? If there were hospitals coming up in Mumbai, they'll affect the hospital. But a brownfield will always be de-risked.
And directionally, what you were asking earlier, right, from our plan is to our each site, right? So, capacity that we created in Mohali occupied, Nanavati occupied. Gurgaon also, which converges the entire Haryana, Rajasthan directionally comes here. So there's significantly very, very large pool of demand that gets served out of Gurgaon.
Hello? Hello?
We have lost the line of the participant. We'll take the next. That is from the line of Karma Vora with Goldman Sachs. Please go ahead.
Yeah, thank you for taking my question.
Hi.
The first question is with respect to insurance. So, just wanted to get a sense, what would be the rough share of, say, top 5 insurers for us, as a percentage of hospital's revenue? And, when we set up a new hospital, 2 ways. One is a greenfield, and the other one is when we do a new tower, in the existing setup. How easy or difficult is the empanelment? So do we get the same rates as our other hospital in the same city, or we have to negotiate from scratch? How does that work? So that's my first question.
So on a brownfield, you don't need to negotiate because the same hospital license just sort of continues into the new. So in case of brownfield, you don't. There's no rediscussion or re-empanelment. What is happening continues. In case of a new hospital, that means a new hospital license, right? If you don't have the empanelment terms already agreed, then you need to empanel. That means you will make those applications per hospital. That's for a new hospital.
Okay, got it. And so sorry, go ahead.
Yeah. I think basically, most of the insurance companies, we have agreed a category of the hospital. It's Cat 1, Cat 2, Cat 3, Cat 4, right? So whenever a new hospital comes up, the discussion is always which category will it fall in, right? So for example, Dwarka now is in Cat 2, Satyajit is Cat 1, right? So it's basically that discussion. Then the rates automatically apply. It's not that we have to get into a negotiation for each hospital separately, right? So we have a set of rates, and obviously, we agree, let's say for Cat 1, we know Cat 1 to Cat 2 difference is so much, Cat 2 to Cat 3 is different so much. So that's how the tariff gets drives with the insurance companies. So typically, it's not that we have to get into a discussion for each hospital. But the discussion is which cat will it fall in.
And the top 4-5 insurance companies would contribute about 24-25% of the group revenue.
Of the insurance.
Got it. Okay, got it. And just one clarification here. So when you say we have categories determined, so how long does it take? So when, say, for example, a Gurgaon, whenever it comes online in the next 1 or 2 quarters, what is the expectation of the full empanelment across insurers? Like, does it take 3 months, 6 months, 12 months? Any rough sense there?
So I would say within 6 months.
Okay, got it. And my second question is with respect to...
because typically you require NABH, right?
Okay, yeah.
You require NABH, and to get NABH, you typically require 6 months of data.
Okay.
Even your institutional patients, take about 6 months to onboard. And you have different rates for NABH and non-NABH. So I think the first gating item for a new hospital would be to get NABH. Also concurrently, various licenses in a greenfield, you need such as, transplant licenses, this, that, etc., etc. So it's not as if in a brownfield, all existing licenses continue. In a greenfield, you need to apply for each one of those. Blood bank license, this license, that license, it's sort of, you can't just start doing liver transplant or kidney transplant or whatever else it is. Your full range of services doesn't start.
Got it. So basically, broadly, 6 to 9 months is where you can get the NABH accreditation as well as the insurance empanelment. That's the rough sense we should have.
That's right. But, it depends now hospital to hospital. Now, of course, this was the same in Dwarka as well for us. But as you're aware, we started Dwarka last July. Right? By now, you're already fully occupied on the 300 beds. Way before now, you were fully occupied on the 300 beds. And you're already planning a brownfield on another 200. And we had a break even within 6 months over there.
Sure.
Right? Although, of course, it was cash patients, etc. So it's about how you also sequence it, right? So I think the very important art over here is how do you preserve cash flow and how do you sequence your event. Now, I could have started all 300 beds or 250 beds over there and so on and so forth. You have to forecast the number of beds, you have to plan accordingly, and you have to staff accordingly. If you're going to staff all the beds, all the this thing, etc., then you're going to lose money. Now, be it with a brownfield or a greenfield or whatever. So I think, that is somewhere you need to be a little more tactful about it.
Got it.
I mean, our total loss for Dwarka in 6 months till break even was what? 30 crores? 30 crores. Up to break even, the total loss was 30 crores. In a brand new market, in a greenfield, in a micro market where we don't have presence.
Got it. And my second question is with respect to, I think, Abhay, you mentioned on the in the opening commentary that, we should be back with respect to growth from Q4 onwards. So just wanted to get a sense. So, do we foresee a step, like a stepped or phased manner of, recovery in growth that, Q4 you might be, partially back and Q1 you should be fully back, or from Q4 it's a complete clean quarter and there should be no one-offs or no deterrents from Q4 itself?
I think the big deterrent on our growth has been capacity. I mean, essentially, if I go beyond the seasonality of it and, whatever one-time disruptions which are back to normal and so on. I mean, everything that we've acquired over the last, or the new capacities that we set up have been ramping up very well. I mean, not ramping, there's been great growth over there. I think 2 years back, the issue was where is growth going to come from? Because already, the fact is you're operating a very high capacity and the growth was going to be coming in essentially from your capacity addition.
Got it.
And there has been that delay, right, of a quarter or two or whatever.
Yeah.
So now that it's online, then, you should be back to trajectory.
Yeah. And the last question is with respect to Gurgaon. Sorry if I missed in the opening remarks. Do we expect it to commission by Q4 end or Q1? And what would be the impact, maybe a quarter or two's impact of losses from Gurgaon, since it's a large greenfield? Any color there will be helpful. Thank you.
I think we'll be H1. I think towards the end of H1 is when you should be able to sort of commission that, the first phase over there. And I'm not going to give you a guidance on the losses, but you have a history in front of you, so you've seen what this thing has been, the recent history and so on and so forth. Because, and I'll tell you why I'm not doing that, right? Because it is a function of the clinicians you're able to get and what sort of this thing you're able to start. I'm happy to make a bigger loss over a shorter period of time and to have a deeper trough. What that essentially means that I've been able to get the clinicians also day one in a greenfield.
Got it. Thanks. That's helpful.
Thank you. Next question comes from the line of Vivek Agarwal with Citigroup. Please go ahead.
Yeah, thanks for the opportunity. So, one question on CGHS, ECHS rates revision. So, you earlier talked about approximately 200 crore kind of a positive impact on revenues, but that is including the impact of discontinuation of some patented drugs, etc., right? So is it possible for you to split it, what is the absolute impact of rate revision and how much of that is likely to be netted off from the discontinuation of patented drugs, etc., right? Thank you.
Vivek, we already said that net is 200 crores, right? So obviously there is this netted of the onco effect, because onco is part of that MOU when the price got revised. So I would say it'll be probably 280 minus 80 type, right? But I must also mention to you that, this whole of price increase hasn't happened in quarter 3. ECHS has revised their prices only in December. some other PSU are asking for, new budgets, etc., to increase their prices with the CGHS level. And also, the super specialty rates within that category will be available from 1st April, right? So, to my mind, the full impact of this will start to come from Q1 of next year, but I think a large part will start to flow from Q4. And also, I must mention that there is a negative impact of GST both on the revenue side and the margin side, right? So I think if I net that out, then you have to net out another 60 crore rupees out of that 200 number. So it will be a 140 number on a sustained positive impact basis in the margin.
Understood. So actually, is it right to understand, right? Like the discontinuation impact of the discontinuation of patented drugs, etc., or the negative impact as well as including the GST, etc. So that is largely in this particular quarter. Basically, the GST plus discontinuation of patented drugs is this in the quarter, and that the positive impact, let's say around 280 crore only on the rates revision, that is likely to come from Q4.
The 200 crores is sustained impact, of the CGHS prices. So the on-top impact will continue because under their MOU, they are saying you will have to give discounts on the chemotherapy drugs by 30%, right? So you only discontinue some of the drugs where the margin was less than 30%. Where the margin was more than 30%, we still continue to supply, but still at a lower revenue, right? So there's the impact. There are two big impact on the CGHS, price increase on the of the oncology drugs. One is that we discontinue some drugs. Some we are giving 30% discount. So both impact will be, as I said, 80 crores. So 280 minus 80. So this 80 is sustained impact, right? So that means net is 200, and then you have to reduce out of that the GST impact. So 140 is the net impact, if you ask me, on the business. Yeah. So it's not one time. I'm saying sustained impact. That means you will have both going forward.
Understood. Thanks. This is helpful. And just one more question again on insurance, right? It looks like that it has been targeted towards Max, while we haven't seen this kind of impact and for the other or some of your other peers, etc., in Delhi NCR. So any specific reason for this? Basically, why it has been targeted towards Max? And separately, what kind of the safeguards that you have that the other insurance companies, let's say, does not do it again in future?
I think hopefully everybody's learned from it. Because I don't think, the disruption is only for Max. I think the disruption would also be for other insurance companies. And there's a reason that other insurance companies did not join in. I think it just sort of made some more media and this time. And, it's been disruptive to patients, right? And patients are also customers of the insurance companies. And therefore, you've seen higher amount of complaints and all the issues and everybody else stepping in.
Understood. And last question on institutional patient share, right? So it has gone up quite a bit, 36%, right? And is again part of this disruption. So any color how to look at this number, let's say 1 year down the line or 2 years down the line?
Well, I think the important thing is that once you're coming up with capacity, okay, the more capacity you come up with, you will have institutional. Exactly to what extent is another matter, but the fact of the matter is you're still EBITDA per bed is higher on even with the lower rates, right? For these capacity additions that you're doing, that is what you're kind of demonstrating right now.
Understood, sir. Thanks. That's from my side.
Thank you. Next question comes to the line of Pansi Desai with JP Morgan. Please go ahead.
Yeah, thanks for taking my question. So my first question is on the growth of our existing hospital beds. So traditionally, if we see, barring any seasonality impact, we still manage to see, good low teens kind of growth for our existing beds, despite the fact that they've been operating at like 75% plus occupancy levels. Partially it could be because of, higher onco share or, robotics, etc., which you mentioned. But as we go forward, do you think, theoretically this has to normalize at some point in time? And, for us, therefore, what could be the levers, which can keep the, growth momentum high, over the next 2-3 years?
No, look, I think, seasonality, if you look at the past 10 years, has been a reality, right? I mean, it's not... and it has the big difference is last year, okay, you had big seasonality, and this year you had actually no seasonality, so it's a little bit of a double whammy. I mean, if you look at the numbers last year, I think we had some 30-35% growth, as a group, year-on-year basis, right, in quarter three. So it was a very high sort of this thing. A lot of it was also due to a little higher part on the seasonality, and whereas this time it's lower. Now, having said that, the big jump in the current year was going to be coming through capacity addition, right? And clearly there has been a quarter to delay as far as that is concerned. So, that is something which should have contributed to increase in revenue. And I think as and when you sort of start getting that on stream, you're going to have that.
Yeah, so Abhay, actually I was just, trying to say that if I actually look at this quarter and if I map it over a 2-year CAGR, this number still suggests a 20% CAGR over 2 years, So, if I remove that seasonality impact, and this is despite the fact that we have not added as many beds. So what I was trying to understand is that it does mean that our existing beds are still growing well, in that low teens, rate. And we've seen that with peers that, most mature beds, beyond a point, once you've reached your optimal occupancy levels, will probably come down to high single digit kind of growth rates, etc. So I was just trying to understand that, from our side, if seasonality were to remain favorable, then, do we continue to see the kind of growth that we've seen?
I think, look, two aspects to it. Okay. One is I'm not looking at peaks and troughs as far as seasonality is concerned. I'm just looking at, okay, on a static basis, if you were to put a straight line through it, what the mean is, right? So I'm not looking at extensive seasonality or it happening or not happening. So that's one. I think secondly, in terms of existing beds are concerned, we've always sort of guided that there are levers, right? I mean, some of the levers get obfuscated because we are opening new beds, but the fact of the matter is there is higher institutional business, okay, which kind of gets or will be getting distilled through it. But as it gets obfuscated by the fact that you're opening new beds, so that again, so there are levers even in the current capacity. It's not as if they aren't. I mean, it depends how you look at it, how you bifurcate this. I don't know if I'm relating to what you're saying.
I think that also as management, our job is to make sure that even the existing hospitals grow, right? So they can grow, one on the ARPOB side, the case mates, etc., and the other is also adding more beds in these hospitals, right? So that's what we're doing. We're trying to do brownfield expansion where in the same campus when you add more beds, the existing hospital also grows, right? So there's no existing bed versus then it's a one hospital that we're trying to grow, right? For example, wherever we have higher occupancies, we try to that brownfield bed there. Existing hospital now, Dwarka is existing hospital, right? So we're adding 260 beds there. So that will make the existing hospital grow.
But it doesn't mean that in Dwarka, okay, while they're putting the additional beds over there, okay, your current mix, okay, is more sort of attuned to, because you've almost got 50% institutional patients over there. And in the first year, you're going to ramp up capacity, you're going to take all sorts of business, and as you go along, okay, you're going to see that distilling.
And my second question is more clarificatory in nature. We mentioned that the GST rate has also had a bearing on our margin. So just wanting to understand, this would have not impacted our absolute EBITDA, right? It would have just impacted our margins because your realizations go down.
No, in fact, absolute EBITDA.
It does, because when you bill to the patients, this bill is at MRP. You don't pay the GST on the margin because these goods are used for delivery of medical services, right? So there is an impact on that.
So that's how Yogesh led to 200 crores net of this thing, and then minus another 60 crores for this thing. You're coming to about 140 crores as a result of this entire CGHS revision as well as GST.
Okay, because I would assume that GST, our realization or EBITDA would have been net of that tax amount, right?
No, I think probably we'll have to get online separately. I'll make you see why this impact margins.
Okay, got it. Thank you.
Thank you. Next question comes from the line of Tushar Manudhane, Motilal Oswal Financial Services Limited. Please go ahead.
Yeah, thanks for the opportunity. So first, clarification, the top 4-5 insurance companies form for 25% of the insurance business? right?
Yes.
Okay.
Yes.
So secondly, we've been doing roughly 400 crore, 420 crore plus minus sort of a capex per quarter, but FY26, I guess the target is up to 1900. So are we on track to do that kind of capex?
Yeah.
Okay. So effectively,
what typically happens, a lot of the capex is back-ended. You don't necessarily relate work done to capex. I don't think it works in tandem necessarily.
Also, when you will do a cash flow projection, you will always do a conservative projection, right? That's how we plan for it, because you don't want the project to suffer because of financial closure, etc. So this will always be, you'll always find that we'll be spending less than what we're projecting because of the fact that we project a conservative number.
Okay. Even if I take roughly 400, 450 crore per quarter sort of a capex, subsequently for FY27 also it will be higher capex, right? I'm not referring to bed addition. I'm not even connecting that to bed addition. I'm just referring to the amount that would be spent for the new hospitals effectively.
Yeah, I think you have the number already in the slide. We will revisit the number at the end of March in any case, and then probably we'll float the new number. But as of now,
but they're fairly conservative numbers. So, I mean, you would certainly not be doing more than that.
And given the current sort of cash flow, which is like roughly 300 crore plus minus cash flow from operations I'm referring to. So does it mean that we'll still have some more debt coming on balance sheet?
No, in terms of
I think the incremental beds that we're getting on stream now, they will start to reverse operating margins. And we mentioned that all these beds are EBITDA as well as margin accretive. So you obviously expect better cash flow from these operations now that the new beds that operationalized.
So which means effectively 2100 crore net debt, is that the number right in FY27 as well? Is that the safe assumption?
No, I think the last time was also this question was asked. I think it will go up by around 500-600 crore rupees in terms of net debt, but it will be still less than 1 unless we do any M&A, etc.
Got it. And just lastly, Smart, there has been like almost 5-6 months delay. So and still like the regulatory approval is to come through. So February 26 is that sort of now largely certain, or that might get pushed further?
So as far as Max Smart is concerned, the original time given was FY28. This project has taken us about 24 to 25 months in its entirety. We expect approvals by end of Feb. It's just got ready now and we've just applied for approval. So there will be no delay in approvals. I want to put that also in place. So it's not as if the project has been lying ready and approvals is what is delaying. Okay, I think the project has been delivered now and approvals have been this thing. We're expecting it by end of Feb. In fact, whatever attendant approvals are, they've been coming through very, very quickly and very smoothly.
Got it. Thanks for that explanation.
Actually, in this one, we've been like I said, ahead of schedule. This one and Zirakpur, we seem to be ahead of schedule.
Thank you. The last question comes from the line of Nitin Agarwal with DAM Capital. Please go ahead.
Hi, sir. Thanks for taking my question. Abhay, you talked a couple of times about the Dwarka hospital, and the fact that we've seen encouraging progress on it to go in for expansion. If you can give us some more color on, what's been the progress, financial progress of the hospital in terms of where it's reached right now, which prompted you to go for expansion at this early stage?
We're already operating at close to 80% capacity, 75% capacity. Although almost half of the business continues to be institutional. Like I said, the life cycle of a sort of hospital, you first ramp up occupancy. Okay. And you ramp up occupancy with all sorts of business, then you start distilling it. So we're already doing 20+%, 20-22% margins over there. 20%? 20% margins at Dwarka. Okay. While 50% of the business is institutional, when we put up capacity now going forward, it will take us at least 2 years to put up that capacity. That means in the better part of 2 years, I will not have beds. Easy to surmise from 75%, we'll probably go to 85%. So I will be distilling it beds, that means we already see month on month, there's more and more cash and insurance patients coming through, and the institutional patients are reducing, and therefore you see the margins move up, right? So that's the encouraging part.
Got it. And secondly, on the JP Hospital, if you can give us any update on the progress on that?
So JP Hospital is doing well now. I think the occupancy has improved, over the period in the hospital. So are you looking for some specific numbers for that?
I'm just curious in terms of from where you acquired to where it's come to, what's the distance we've covered in terms of performance improvement in the business?
So I think if I take Y on Y, it will be more than 30% growth, right? We took this in same quarter last year. So the revenues are up by 30-35% range. EBITDA is also up accordingly. Obviously, I'm not giving you the specific numbers in terms of revenue setup, but I think that's the state it is. So and when I say 30% increase in revenue, that obviously means that the revenue has come down first, because when we acquired the hospital, we stopped all the referrals, etc. The revenue tanked a bit, and then we brought it back. So the 30% growth Y-o-Y same quarter is basically after that dip which happened in the first quarter after acquisition, and then we build it up. So the real growth would actually be around 40%.
And in terms of profitability, is it now closer to your network profitability? How far is it from there?
No, it is not. It's less. So I think the first endeavor was to stabilize the operations. We had a lot of complaints in that hospital, right? So we were working on that. I think margin is probably 3-4% lower than the overall margin that we have in the networks.
And secondly, when we look at our business, for the next couple of years, the EBITDA per bed for us has been a pretty dramatic journey which we've had over the years. Around 75 to 7.5 to 8 million is where we are at. I mean, does the network EBITDA stabilize around that, or you do see opportunities for us to significantly increment it from these levels? And how should we think about EBITDA per bed? So when you take a 2-3 year view from here?
EBITDA per bed.
No, so we don't go towards the direction for chasing a EBITDA per bed also as a base, right? So our trajectory is to deploy capital efficiently to have yields on the capital. That may be an outcome of
we may have a lower EBITDA per bed, so you have to focus on ROC over there, right?
Yeah.
I mean, we're not focusing on making EBITDA per bed or ARPOB accretive or whatever. We are focusing on ROC.
Fair. And if I take the last one on the over the next 2 years, from where do we see our operational beds sort of hitting out? We are about 46% operational beds right now. Where do we end up in the next 2 years?
I think we are higher than 40.
4,800.
We're 4,800. I think now you're adding another, close to 1,000 beds now, and another 1,500 including Gurgaon. So that's 6,500, and by 28 you should be hitting 8,000? 8,500?
Yeah.
Roughly. I think it's you just added up, it's in the presentation.
About 18,500 where should
I just look at the presentation, love the exact this thing, by 28, 27, 26, 29, somewhere. Presentation, I think it's on the...
Okay, thank you so much.
So location-wise it's there, no? Location-wise, how many beds? How many are brownfield, how many are greenfield?
With respect to the delays and all that you foresee, by the time you finish F28, you still more or less in the same ballpark that we had in the presentation, is what I meant.
That's right. So, I mean, we've given it out in the presentation, updated numbers. This current quarter's listing will be updated for any delays.
Okay, perfect. Okay, thank you so much.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining us today. We appreciate all your time and look forward to interacting with you again next quarter. Thank you very much.
Thank you. On behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.